Welcome to Chapter 21 of the Canadian Securities course, Volume 2. This chapter is going to be a follow-up of Chapter 20, where we talked about alternative investments. But in this chapter, we're going to delve a bit deeper and look at the strategies and performance of alternative investments. So first off, the alternative investment strategies. We did go over this in the previous chapter. But again, to recap, we have relative value strategies, event-driven strategies, and directional strategies. So the relative value strategies, they attempt to profit by exploiting inefficiencies or differences in the pricing of related stocks, bonds, or derivatives, whereas event-driven strategies seek to profit from unique corporate structure events. Direction strategies are a bit different than the two. They bet on anticipated movements in the market prices of equities, securities, debts, and foreign currencies, as well as commodities. So all three of these strategies are a bit different, and we will be going into each strategy and explaining how each strategy actually does work. So the first relative value strategy that we will be looking at is the equity market neutral strategy. It is designed to exploit inefficiencies and opportunities in the equity market by creating simultaneously long and short matched equity portfolios of approximately the same size. So the strategy is broken down into 6 different steps. First off, you will review both of the companies to determine if there is mispricing between them, and you'll compile a list of potential trading pairs. Next, you will examine the pairs in the context of the current and historical price spread relationship between the two, because that's where you're going to be getting that arbitrage, is the price spread between the two securities. You're going to choose the pairs the investment manager would like to initiate as the trading pairs and execute the trade. And after, you will enter the initiated trade into a real-time portfolio management system along with the price target spread at which the trade will be reversed to realize the target value. So it is a bit confusing going through that, but I do have an example that we can go through to make it a little bit more clear. Now, this example used RBC as well as TD Bank as two stocks that they wanted to use. And basically, they wanted to find the price spread between the two. They actually purchased RBC and they shorted TD. That's because they began this when the price spread was lower. So the price spread normally has a mean of about $28 as a difference between RBC and TD. So RBC was $28 more expensive. But they found that this price actually reached the second standard deviation, and the price spread decreased to $22 in between for the price spread of RBC and TD. So because of that, TD is expected to be a little bit overvalued because the spread is lower. It's closer to the value of RBC, so you'll want to short that stock. And you'll also want to buy RBC because also that will be a stock that is considered to be a better value compared to RBC since the spread is lower and you're expecting it to increase. So if you go through this example, you can see that you will make money if you purchase it when the spread does increase, or when you reverse the trade when the spread does increase. So they started it by shorting $740,000 worth of TD stock and purchasing the equivalent dollar amount of the RBC stock. Next, when the price spread did increase and it reached sort of around the mean, they reversed the trade. So you would have to sell your RBC shares, and with the proceeds, you'll buy back the TD shares that you shorted, and there will be a return on that money. So that is one way to use the equity market neutral strategy. Now, another relative value strategy is convertible arbitrage, and this is designed to identify and exploit mispricing between convertible securities and the underlying stock. Now, convertible securities, they have a theoretical value that is based on a number of factors, including the value of that underlying stock. So when the trading price moves away from its theoretical value, an arbitrage opportunity exists. So it does involve buying the undervalued convertible security and hedging some or all of the underlying equity risk by short selling the appropriate amount of issuer common shares. Now, I do have an example for convertible arbitrage as well that was in the textbook. So going through this example, we're going to start with the photo that I put on the right. So step number one, you really want to figure out what you're going to be buying and shorting. In this example, we have Tesla, so the Tesla stocks and the Tesla convertible bond. And they look at the price spread between the two using the equivalent amount of stock that the convertible bond is worth. And you can see that the mean is, right around $200. And it actually reaches near one standard deviation below the mean. So that's when they began the trade. And to begin it, they short sold 2.7788 shares of the Tesla stocks, which is the convertible amount of that bond. Now, with the proceeds, you are going to be purchasing the Tesla bond. You also do have to pay a little bit more sometimes. So that's how you will initiate the trade. The next step here is going to be waiting a little bit. You can see that they wait till the price spread is back up near the mean, and then you can reverse the trade. Whenever the spread does increase or go in the favorable direction, then you can reverse it for a profit. And to do this, you'll sell the convertible Tesla bond for the proceeds, and you'll also purchase back the shares that you short sold, and there will be a profit here. There is also a relative value strategy for fixed income. It's called the credit spread arbitrage. And for this, you will rely on the ability to predict the future direction of interest rates. And we do have an example for this as well. And so for this example, we will be using RBC bonds and Bank of Canada bonds. And again, you're going to be making a price spread comparison for the two. So for this one, the mean is right around, let's say, 0.8. And the standard deviation above is 1. And you can see that the price spread reaches that. And that's where we initiated the trade. So to start, we decided to initiate it when it reached that 100 basis point or more spread. And then we decided we wanted to reverse it when it reached that one standard deviation below, which was the 70 basis point spread. So we're going to start by shorting the $1 million worth of Bank of Canada bonds, since it is sort of overpriced at the initiation point. And with the proceeds, we'll purchase the equivalent amount of RBC bonds. And once we reach the one standard deviation below, or the trade reversal point, we can just reverse it by selling the RBC bonds and purchasing back the Bank of Canada bonds that we did short, and there will be a profit there. Now we do have a little bit of a definition for yield spread arbitrage. So managers of yield spread strategies, they do attempt to add value by demonstrating their skill at forecasting the shape of the yield curve at a future moment. So for example, if the manager believes that the yield curve will flatten, so the difference between the long-term and short-term rates decrease, then they will sell the shorter dated securities and purchase the longer dated securities. And that's because they do want to take advantage of that interest rate decreasing. So basically they will want to buy the long-term bonds because they will have a higher interest rate relative to what they will be when the interest rate does decrease. So they want to be locked into that position for a longer period of time. There is an example of yield spread arbitrage. It basically is what I just explained. It does start with you determining if you think interest rates are going to increase or decrease. If interest rates are going to decrease, you're going to want to increase your long-term bond position, and you can short the short-term bonds. And if you think interest rates are going to increase, you'll want to do the opposite, short the long-term bonds and buy the short-term bonds. So now we're going to move into event-driven strategies. These are quite simple to understand since you are going to be looking at profiting from corporate structure events. So the first one is the merger strategy. And this is when you'll try to take a long and a short position in the common stock of companies involved in a proposed merger or acquisition. The strategy usually does involve taking a long position in the company being acquired and a short position in the acquiring company. So the manager does attempt to take advantage of the differential between the target company's share price and the offering price. There usually is a gap here because of the risk that the deal may not close, and we went over this in a previous chapter. It's the deal break risk. So you can take advantage of that sort of risk there and profit off it. That's why it is sort of risk arbitrage, because there is an arbitrage opportunity, but there's also that deal break risk that you might actually lose money on. So the returns on merger arbitrage, they are largely uncorrelated to the overall stock market. So it is a nice alternative investment strategy so you can get some uncorrelated returns. Now, in terms of high yield bonds, there is a high yield bond strategy. And basically high yield bonds, they are a type of credit strategy that invests in below investment grade debt securities. So high yield bonds or junk bonds, they're usually rated BB or lower. And you do have the distressed securities strategy. So this is one that will be important to know for the exam. You might have a question on it. This distressed securities strategy is when you invest in the equity or debt securities of companies that are in financial difficulty and facing bankruptcy or reorganization. So these often sell at deep discounts since the risk of them going bankrupt since the risk of them going bankrupt is much higher than a more successful company. And if they don't happen to go bankrupt and they do manage to sort of restructure or liquidate the company, it will lead to greater returns than the cost of the bonds. Now, in terms of directional strategies, these involve high exposure to market direction. They include long and short equity strategies, global macro strategies, emerging market strategies, and the dedicated short bias strategies, along with managed future strategies. So there are a lot of different directional strategies that we are going to be going over, and we're going to start with the long and short equity strategy. So to start, we have the long and short equity strategy, and this is when the manager has neither a net long or a net short exposure to the stock market. So with a long or short equity strategy, managers try to buy stocks they feel will rise more in a bull market than the overall market. And then they will short sell the stocks that will rise less. And then they'll do the vice versa in a bear market. So if they are able to predict the market correctly, then they should have sort of success with this strategy. However, of course, there is that risk that, your short position has unlimited liability risk. So there is some risk to just shorting stocks in general. Now, in terms of net exposure, you might need to know this for the exam. It is equal to long exposure minus short exposure divided by capital. And there are two different strategies here. You can combine equity market neutral portfolios with a long or short position in suitable equity index futures. And the other strategy is portfolio managers create a portfolio of pair trades, where the long position does not equal the market value of the short position. Now, the next strategy is the global macro strategy. This strategy makes bets on major events affecting the entire economy. So it's sort of that macro type strategy. So some examples of some things that might affect the entire economy include trade statistics, corporate earnings, exchange rates, domestic and foreign policy developments. All these type things will affect the entire economy, and you can sort of bet on those. There are two different styles of analysis when you're looking at global macro strategies. First off, you have discretionary managers. So these construct portfolios using a top-down analysis approach, and they analyze the world economy. Their goal is to predict the direction of underlying markets and asset classes. Next, you have the systematic managers. So they construct portfolios using a bottom-up analysis approach, and they employ the use of models and algorithms on large sets of economic data. Their main goal is to predict the movement of financial market prices. So there is a bit of a difference here. The top-down approach, or discretionary managers, they look at the whole economy and predict the direction of the underlying markets and their asset classes, whereas the systematic managers look to predict the movement of financial markets. So next we have emerging markets. So there are emerging markets alternative funds, and you can invest in equity and debt securities of companies in emerging markets, and it is a nice alternative investment to use. And do keep in mind that emerging market funds is different from an emerging markets alternative strategy fund. The strategy does have greater ability to use derivatives, short selling, and other complex investment strategies. And also, managers look at economic and political factors when choosing the type of securities to invest in. Dedicated short bias. So dedicated short bias, to be classified as short bias, the fund's net position must always be short. So that's what this strategy basically is. You have to always have a short position. In other words, the fund may have long positions, but on a net basis, the fund must constantly be short. So the advantage of having short and long positions rather than having only naked shorts is that the long positions can help keep losses on the shorts manageable during extended bull markets. So this dedicated short bias, you'll only want to use it if you think we are in a bear market. If you think the market is decreasing, then this would be a good strategy. However, it is an extremely risky one since, as I said, short strategies or short selling, they do have unlimited liability. The price could theoretically increase to infinity, and you would have to pay that back somehow. So short positions, they are risky, but they can be useful in certain situations. So the main risk from this is just maintaining that margin balance. And yeah, that is the dedicated short bias strategy. We also do have managed futures. So this strategy commonly refers to a portfolio of future contracts that is actively managed by professionals. You have two trend following strategies that managers can employ. First off, you have the time series momentum strategy, and this uses fundamental analysis and historical prices, so technical analysis, to identify market trend signals. The strategy assumes that assets with a positive negative trend will continue, and investors long the positive trend asset and short the negative trend asset. You also do have cross-sectional momentum strategy, and this strategy takes positions in pairs of securities based on relative signals. So the manager will take a long position in the security with relatively positive momentum and short the security with negative momentum. So it is quite similar, both of these two strategies, but the only difference is the momentum or the trend. So the time series momentum looks at the trend, and the cross-sectional momentum looks at the actual momentum of the security. There are some advantages to this strategy. It is highly liquid and there are low fraction costs. Also, there is complete price transparency with this strategy, and it does facilitate direct access to underlying risk. Now, the multi-strategy funds. So in a multi-strategy fund, a single fund manager invests in multiple fund strategies within a single fund vehicle. And this provides reduced volatility and potential for enhanced risk-adjusted returns, as well as reduced concentration risk. You also do have multi-strategy funds that have single managers who operate several different hedge fund strategies. And this is different to a fund of funds, which we covered in a previous chapter, since this is managed by different managers. There is also another strategy, which is the leveraged ETF strategy, and it's designed to achieve returns that are multiples of the performance of the underlying index it tracks, and they do this by using borrowed capital. So we looked at the dedicated short bias strategy. This was a great strategy to use if you think we are in a bear market. Whereas the leveraged ETF strategy, it is sort of the opposite. It's an amazing strategy to use in a rising market, but terrible in a falling market, because you are going to be getting that amplified returns. So of course, if we increase, you'll get higher increase. If we decrease, you'll get a lower decrease, or a higher decrease, I should say, with the leveraged ETF strategy. And also another thing to note with this strategy is that if the leveraged ETF rises 3% from 100 to 103, the leveraged value will actually rise from 200 to 206. So now your factor will be less than 2, so you might need to increase the leverage position and borrow more to actually maintain that double leveraged position for your ETF strategy. There are some risk measures to all of these. These are just some general risk measures that you guys should know about. First off is the absolute risk. So this is the total variability or volatility of returns. And it incorporates all sources of risks embedded in returns, including first and second order risks. Standard deviation measures the extent to which returns differ from some average or expected level of return. And the downside is that it does penalize upside volatility as well as downside volatility. The Sharpe ratio is another risk measure. It measures excess returns generated above the risk-free rate per unit, and it is sort of measured by standard deviation. Now, along with standard deviation, you do have the bell curve. So the bell curve really does show how data points are distributed, normally distributed. So basically, approximately 68% of all returns lie within one standard deviation of the average or expected return. 95% lie within two standard deviations, and 99% within three. Now, you can have a bell curve with a skew or a kurtosis. So a bell curve with a skew, it does measure the extent to which a distribution is tilted either towards negative or positive returns. So basically, your bell curve, it will be tilted somewhat, and it might be sort of skewed in one direction. Now, kurtosis, this measures the tendency of a return distribution either to have values that collect around the average of all returns. So that would be low kurtosis, meaning most of the values are around the mean or in the center of that bell curve. And if the bell curve has a higher kurtosis, then a lot of the values will collect towards the tails. So the bell curve will be flatter and the tails will be a bit higher. So more data points could be along the outlier section. Another important thing to go over for this chapter is the due diligence process. There are 8 primary areas of inquiries. First off is the structure of the investment management organization. So that's something you should look at before investing in alternative investments. Second is investment management information. Third, you're going to look at the risk analysis as well as the operations. Fund structure is really important to look at as well. And also investment performance, account structure and composition, and of course, the fees. Now, what are some suitable investors for these alternative investments? Suitable investors, they usually do have the following. So they have experience investing in mutual funds and knowledge of diversification, efficient markets, derivatives, and short selling. And you sort of do need to know that knowledge because alternative investments, they are quite complicated, and it's something you really do need to understand before you do start investing in them. Suitable investors will focus on absolute returns as well. They just want to make as much money as possible. And that is probably everyone, but there's a big difference between absolute returns and relative returns. Also, medium-term investor horizons does sort of connect suitable investors with this strategy as well. And investors that do prioritize liquidity will also benefit from the alternative investment strategy. So anyway, that is everything for this chapter of the Canadian Securities course. That is everything for the alternative investments portion. It is probably one of the most difficult portions in the Canadian Securities course, or volume 2 at least. So I really hope you found this chapter helpful and was able to help you learn and study for your exam that may or not be coming up. But anyway, thank you guys so much for watching. I really hope you did enjoy, and stay tuned for the next chapter.